Good afternoon and welcome to Capital Account. I'm Lauren Lister here in Washington, D.C. These are your headlines for April 26th, 2012. A date is now set for the kickoff of U.S. President Barack Obama's re-election campaign. It's May 5th. So as we head towards elections and a debt ceiling debate, mind you, is the biggest tail risk for investors the intersection of reckless fiscal policy combined with jelly donut monetary policy. We'll explain and we'll talk about it with Grant's Interest Rate Observer editor, James Grant. And speaking of the Fed, yesterday it reestablished what our guest calls its midget interest rate policy. So are central banks doing this to the price mechanism of supply and demand? I'm talking about waging war. We'll discuss. And you didn't think the Fed press conference yesterday was just about trying to get clues about QE, did ya? Well, Bernanke took shots back at fellow academic Paul Krugman over accusations he isn't acting academic enough. We'll talk about what's wrong with this picture, but let's get to today's Capital Account. So while we're all still probably digesting a little bit the news out yesterday from the Fed, I'd like to bring your attention to some central bank news you may actually be more receptive to, because last month, the Federal Reserve Bank of New York invited some of its critics, including our guest, to, as he puts it, unburden themselves of their criticisms. Now, the text of his remarks were published in the March 23rd issue of Grant's, and it is definitely worth reading for those of you who are wise enough to subscribe. Now, there are a number of points that Mr. Grant makes in his remarks that we have repeated on this show ad nauseum ourselves: accountability for bank executives, a functioning price mechanism, sound money, capitalism. But the editor of Grant's Interest Rate Observer also makes another very interesting proposal with respect to what he would do if, by some act of market revenge, he were made chairman of the Monetary Priesthood. He would, as he puts it, commission, staff, and ceremonially open the Fed's first Office of Unintended Consequences. Now, this would be his pièce de résistance, because economics, after all, is a social science, and as such, is beholden to the unintended consequences brought about by the actions of the observer as much as by those of the subject being observed. In other words, the Fed can't hope to objectively understand the economy, since it itself is the biggest actor in it. So imagine if we designated responsibility for precipitation and cloud cover to executives at the Weather Channel. Now, even if this new politburo had the best intentions, would you really feel comfortable handing over control of the weather to a group of 12 unelected, highly fallible human beings? We don't think so. And if you believe the weather system is not a fair comparison to the system of money and credit, we would beg to differ. The weather, as well as the economy, are both chaotic systems. They are dynamic. They are organic. They are not well-oiled machines to be manipulated and driven from point A to point B at the discretion of some ceremonially chosen motorist, no matter how pure or how well-meaning his intentions may be. But how would the economy function without the central planners and their open market operations? How would the sacred rate of interest be determined without the shepherds at the Fed? Surely there must be someone to guide the economy. To help guide us in the pursuit of answers on this and other topics is James Grant. He is founder and editor of Grant's Interest Rate Observer and author of this book you see here, Mr. Speaker, The Life and Times of Thomas B. Reed, the man who broke the filibuster. And we are so happy to welcome him back to Capital Account. So first, thanks so much for being here, Mr. Grant.
You are entirely welcome. I am delighted. And by the way, I can report that it's raining outside in New York City.
We are glad to hear that there is a rainy day right now, because that is fitting to talk about the Federal Reserve on a rainy day. So let's get right to it, because as I mentioned, you actually went and spoke with the New York Fed last month. And of course, yesterday we heard from Ben Bernanke in a press conference after the FOMC announcement. So did you hear anything in Mr. Bernanke's remarks that maybe made you feel like your criticism and your advice has been heeded?
Not so much as one dependent clause. You know, my speech at the Fed was a wonderful experience for me. I'm not sure about for my audience, but they were most appreciative, it seemed. Their applause was more than perfunctory, and they laughed once or twice at the appropriate places. But at the end of it, and most of the questions were quite good, there was one question that, the more I think of it, the more telling it is of the Federal Reserve and what one might call its Atlas complex, that if it weren't there, we couldn't get up in the morning and go to work. And the question was, I had talked about the depression that Ben Bernanke never mentions, which is the one beginning in early 1920 and ending in mid-1921, a brutal and ugly affair, which, however, came to an end despite the utter absence of federal stimulus. Indeed, the Treasury balanced the budget, and the Fed actually raised its short-term rate of interest. So I talked about this to the people in the audience at the New York Fed, and someone raised his hand and asked, well, wasn't there mass starvation? No, there was not mass starvation. But I thought the question was so telling of the attitude of our monetary, as you said so well, monetary priesthood. Unless they are actively at prayers and devotions, who knows what might happen.
Right, and maybe the perception or the mythology around what happens in their minds if they don't act. That's a really interesting anecdote. Let's talk a little bit more about what you've been talking and writing about, because the title of your latest newsletter is For the Price Mechanism, and in it you say, or write, quote, "The world over, governments and central banks are waging war on supply and demand, on the price mechanism." So, you know, how exactly do you feel they are waging a war on prices? After all, you know, here I am thinking that we're in a free market prices. So how do we explain?
Well, to be sure, on the whole, in America, most prices are not manipulated overtly by the federal authorities. We don't have in this country, as we had, say, in the early 70s, wage and price controls. But and this is a very important but, we do have a controlled financial market. We have interest rates manipulated, indeed set, by our masters at the Federal Reserve System. You know, Chairman Bernanke gave a series of lectures to the students at George Washington University a couple of weeks ago.
That's right.
And in these lectures, he was asked about the wage price controls of the early 1970s, and he deplored them. He said that they were a terrible idea, that they distorted the economy, and that prices, after all, said the chairman, prices are the critical guiding mechanism of a market economy. Now, that was the chairman talking to the students. The chairman, in his day job, is busy suppressing the short-term interest rate in this country at 0 and guiding or manipulating other interest rates just as critical as the federal funds rate through the length and breadth of what we call the yield curve, meaning the continuum of rates over time. You know, interest rates are the traffic signals in a market economy, especially its financial economy. They contribute critically to our perception of value in stocks, bonds, real estate, what have you. And because these rates are manipulated, specifically suppressed, crushed, we live and invest in a kind of hall of mirrors. We can't exactly be sure that what we're seeing is the thing itself, or rather the contorted image of the thing seen through the prism of the Fed's handiwork.
So let's talk a little bit more about some of the consequences that you perceive. One of the speakers at your latest conference, David Einhorn, a hedge fund manager, he compared the Fed's zero interest rate policy along with quantitative easing as a diet of jelly donuts that people are getting sick on. And basically, the combination of this monetary sugar high along with reckless fiscal policy, that this is actually what investors are perceiving as presenting a huge tail risk, and that this could actually be depressing stock values in the long run.
Well,
what do you think about this analysis?
Tail risk, yes, tail risk is one of these fancy terms for overhanging anxiety or apprehension about something that may not happen, but if it does happen, will be deeply upsetting. And it's my view that that in this country, in America, there is this miasma of anxiety, of doubt, of apprehension concerning our financial and economic affairs because of the sheer, among other things, because of the sheer unpredictability of governmental action. If we don't know, and we do not know, what they will do next, we can't really plan for the future. Will the Fed keep its interest rate at zero through 2013, through 2014? Well, we don't know. We have opinions. They tell us every 6 weeks or so what the members of this Federal Open Market Committee are thinking. But we can't really be sure. Therefore, we can't really plan. Therefore, it seems to me the economy can hardly swing its legs out of bed in the morning. You know, it is recovering after a fashion, but the recovery is most halting, most un-American. This is a country that has that's characteristically and typically a kind of a recklessly joyous way about it with regard to investing and economic growth. It delights, does America, in going for it, in taking a chance in the future. But if the future is manipulated significantly by our masters in Washington, a kind of a subtle, in as much as it's not really visible to the quantitative-minded economists, but an important change comes over the mind of the people. And so that, to me, is that's my reading of the present day. But notice, 2012 is an election year. In June, I think the Supreme Court is going to weigh in on the constitutionality of Obamacare, and we have an election in the fall. It seems to me that there is some chance, and this would be very bullish indeed, there's some chance that that this governmental war on the institution, the innocent and indispensable institution of supply and demand, that this war might be suspended significantly, in which case I think it'd be terrific for America and its investors.
In what situation would the war be suspended?
Well, if, for example, if Obamacare, if the president's all-encompassing and it seems to me, suffocating program of federal regimentation of this important segment of the economy was overturned, that would be an important step towards the institution of enterprise. And if the Republicans won a big majority in Congress, and if Mitt Romney won the presidency, it seems to me the way would be open at least for congressional reconsideration of the remit of the Federal Reserve. The Federal Reserve, after all, is a creature of Congress. So I am, hugely disapproving of the way things have been going. Many are, but in my disapproval, I don't mean to rule out a reversion to something like the characteristic American institutions of enterprise. It's just possible we might see them later this year.
That's interesting. Those are pretty high hopes for Washington. Sitting here in the district,
yes, they are.
It's hard to be optimistic about those kind of actions actually ever happening. I want you to stay right there. We're going to go to a quick break, but when we come back, we will have much more with you. That's James Grant, founder and editor of Grant's Interest Rate Observer. And still ahead, from the gold standard to the PhD standard, is there any going back? We'll have more with James Grant. And first, your closing market numbers.
We just put a picture of me when I was like 9 years old on To Tell the Truth.
I have a confession. I am a total ghetto princess. I love rap and hip-hop music and Christian music.
I thought he was kind of a dick yesterday.
I'm very proud of the role that Al Jazeera has played.
You know how sometimes you see a story and it seems so whole and complete, you think you understand it, and then you glimpse something else. You hear or see some other part of it and realize everything you thought you knew, you don't know? I'm Tom Hartman. Welcome to The Big Picture.
What drives the world?
The fear-mongering used by politicians.
Who makes decisions?
Considerable breakthrough has already been made.
Who can you trust?
No one who is imbued with a global missionary zeal.
Where are we heading?
State-controlled capitalism is called fascism.
When nobody dares to ask, we do. RT, question more.
Welcome back. We've been talking with Jim Grant about the Fed's manipulation of the future. So let's talk about of the present. So let's talk about what this means for the future, because another speaker at his recent conference was the deflation-wary Hugh Hendry. And he laid out a case that what will likely precede the eventuality of inflation is actually the polar opposite, a severe deflation and the collapse of mercantilism Asia style. Now, this has been one of the more popular debates raging in the financial blogosphere, going on at least 5 years. Now, we talk about this a lot, so let's hear our guest's view on it. Let's bring back Jim Grant, founder and editor of Grant's Interest Rate Observer. So, Mr. Grant, where do you stand, in your view, on this inflation-deflation debate?
I think it might be a good idea to briefly define terms. It seems to me that the deflation is a derangement of debt. If there's a debt crisis, you can't finance, you can't borrow, you can't hold inventories, therefore you sell stuff. You can't hire, therefore you discharge employees. The sum total of these actions leads to falls in wages and prices. That, to me, is deflation. What deflation is not, it seems to me, is the reduction in the price, the cost of producing things in a time of spreading digital technology and the opening up of new areas to enterprise and to production. That I would call progress. Now, the symptom of both is falling prices, but the Fed refuses to distinguish between a problem of debt and progress. The Fed seems to be resisting the latter, which leads to intervention, which leads to money printing, which leads to the suppression of interest rates, which finally leads, ta-da, to inflation. So the Fed, by reacting to the thing it calls deflation but refuses to define, is actually instigating the final thing, inflation. Now, that's by way of preface. You asked me which comes first. And I'm glad I had so much time to search for an answer, because I'm not sure I know, Lauren. I think that in Asia, there is a terrific debt crisis brewing. It seems to me that the Chinese financial structure is both corrupt and corrupting. The banks are propped up by the state. Prices are set by the state. Interest rates ditto. There's immense exercises in what the academics call malinvestment. We ordinary people might refer to as the production of white elephants, great buildings without people in them, shopping centers without shopping, railroads that run off the rails. So in Asia, it seems to me there is a setup for a great collapse in prices. I don't know, and I'm not sure anyone does know what comes first, but I can certainly see that monetary authorities the world over are doing their best to bring about inflation.
That's interesting. Where do you think this goes as far as the way it plays out? I'm curious if you have any ideas about alternative currencies that come about that are either determined by the market or determined by some kind of international institution like the IMF with SDRs.
I think that whatever happens in our monetary future, it will not involve the special drawing right, or SDR, which is a currency only an economist could love. Indeed, only an economist could understand or recognize as money. The monetary substance that is in front of us, that is in our language, apparently in our bloodstream, is of course gold. It's the thing that people recognize. It's a universal, an image, I suppose, is gold, as Muhammad Ali. People the world over know what it is. The central banks of the world mainly resist the idea of gold as money, although interestingly, central banks have been accumulating gold collectively the past year or two, as they haven't in a generation. It seems to me that the institution in place, that is to say, worldwide paper money and the worldwide manipulation of interest rates by bureaucrats, this monetary setup is not for the ages. It is destined to fail. Indeed, it is failing. Something will supplant it. And it seems to me that something is very likely to involve gold. Now, whether it's going to involve a new gold standard, that's my preference, or whether it's going to involve, say, the Ron Paul approach, which is the denationalization of money through the abrogation of the excision or the whiting out of the fiat currency system through the legal tender law. So as it is now, it says on a dollar bill that you have to accept it in payments of debt. That's the law. Well, if legal tender laws were no longer in place, people could choose. They could decide what is money as they view it. It seems to me a much better system would be an international arrangement whereby we establish this universal system of weights and measures called money, and we define it in that thing which seemingly is meant to be money, namely gold. That's my preference.
Well, and that's interesting. I know that you are, and you've kind of laid out your support and your admiration for a classical gold standard, whatever the faults that some people may perceive. In a global banking system, though, where there is so much debt, it is so awash in debt, it doesn't seem that this kind of monetary discipline would be what any financier would go for. So do you think that it actually is possible that there actually could be a movement towards a gold standard in reality?
I think it is entirely possible. And I think that people have just about had enough of our overfed, needy, and only cyclically solvent financiers. And the collective voice of these financiers in the councils of state, I think, is properly being marginalized. I'm not sure if the people are going to rise up in the next election. I'm not sure what the voice of the people in this respect is exactly going to sound like or when it might be heard. But I have to believe that people have had enough of 0% interest rates for the savers, for an artificially supported prosperity for the undeserving financiers. I can see every political piece of dry tinder in place ready for the match. I'm not sure when the match will be dropped.
That's an interesting point. Along the lines of those financiers, what do you see as far as accountability? Because, of course, we've seen actions like Dodd-Frank, which have plenty of problems. They haven't ended too big to fail or any of the sorts. I know you do. I was going to get to that. The Isaac Clawback plan. Tell us about this and how it makes up for what Dodd-Frank misses.
Yeah. So here, I'm going to give you two alternatives, Lauren, and you can pick one. You must pick one, and you must pick the second one. Okay, the first alternative to promoting accountability within the banking system is the 2,500 and odd page Dodd-Frank bill, which micromanages the actions of our bankers. By the way, I submit to you that the only population in America that knows less about banking than bankers today is the U.S. Congress. So that's choice A. Choice B, the correct choice, Lauren, is the Isaac Clawback plan, which I've named after my pal Paul Isaac, a Wall Street investor who dreamt it up. This plan would require that anyone in a regulated financial institution making 10 times the average manufacturing wage or more, that's about $400,000 and up, anyone making $400,000 and up would surrender that increment above $400,000 for 7 years preceding the insolvency of the institution for which he or she worked. So the problem now, as I see it, is that bankers take risks. They don't bear risks. What is wanted in a capitalist society is the union of risk-taking and responsibility for actions taken. What is wanted is capitalism on the upside, but no less capitalism on the downside. And it seems to me that one could opt for the unworkable bureaucratic morass that is our current regulatory regime, or one could harness the venality of our bankers to the public good and say, all right, you know about banking, or you should. The bank for which you work in an executive position will be solvent. If it's not, you will not have the money you so seemingly desperately must have.
I love that whole idea. I mean, personal responsibility, personal accountability. Hey, you want to take these risks? Fine, but your skin is on the line instead of the taxpayers. I want to keep this going.
Sorry,
go ahead.
Oh, I was going to go off on a tangent, but please, you go off on yours.
Well, no, we have a few minutes left, and I want to keep you on through this last segment that I'm going to just scratch because it's such a great pleasure to have you on the show. So I do want to ask you about this because it has been roughly 5 years since the Fed began what one could argue has been the most reckless experiment in money printing since that paper was digitized after World War II. Because assets must be bought in order for money to be created, what exactly do you imagine the Fed and other central banks that have done the same thing plan to do with all the debt they've accumulated on their balance sheet since the crisis in 2008?
Well, in fairness to our monetary mandarins, they do have a plan. They do have a plan. And the plan, for example, the Fed's plan, is to gradually raise the rate of interest it pays banks for keeping about $2 trillion lying fallow, as it were, doing no harm on the balance sheet of the Fed. Now, this takes just a moment of explanation. So you mentioned in your question that in order to purchase these treasury bills, bonds, and mortgages, the Fed must print the money to do so. That's central banking 101. It does that. It prints, it materializes money that didn't exist before in order to buy the securities with through which purchase it manipulates our financial system. Mm-hmm. So the question you ask is a very good one, namely, what happens to these bills, bonds, and mortgages that the Fed and other central banks have accumulated in such unimaginable volume? Where do they go? And do they have to sell them? So the Fed's idea is that it will immobilize the dollars it created to buy these things by dexterously raising or manipulating the interest rate on the dollars the commercial banks have on deposit at the Fed. Now, that is perhaps partially intelligible, but the central point is that the central banks believe that they have the nimbleness and the judgment and the foresight to kind of manipulate away these vast quantities of currency they have created to fight these wars against free interest rates. My suspicion, in fact, my contention, is that the problem is not their lack of technical means to do something to forestall the day of reckoning, but rather the question is one of judgment. Our central bankers had no clue that our sorrows were upon us in 2007, and I think they will likewise be late to the party when time comes to do the thing they promised to do to prevent the new inflation.
The PhD standard that you referred to, we're going to have to leave it there for today. We're out of time. I really appreciate you being here. Thanks for being on the show. That was Jim Grant, founder and editor of
Thank you, Laura.
Grant's Interest Rate Observer. And that's all we have time for. Thanks so much for tuning in. Don't forget to follow me on Twitter @LaurenLister. Give us feedback at youtube.com/CapitalAccount. And from everyone here, thanks for watching and have a great night.